Now, I would spend the next 10 minutes giving you a list of the best cities to invest in, but instead, I'm going to teach you how to make that list yourself, which is much more valuable because the most successful investors, they don't just magically pick unicorn markets to operate in. They pick markets systematically using the rules that I'm about to give you in this session that they know they could predictably and repeatably make money in. So get your pen and pad out. It's going to be a good one. We're going to kickstart it with a giveaway, 25 free copies of anything from the ACE Toolkit store, the legendary rental property calculator included. It's going to be available through our link in bio or the link floating over my head on YouTube. And the coupon code is going to be all lowercase, one word, cities, CITIES. And it does not work for the virtual investors guide. The course has never been discounted, but if you're serious about buying rental property out of state, which I'm sure a lot of you are if you're watching this session on Picking Markets, it has this gory, in-depth session on what we're talking about today with a live demo. It'll show you exactly how to make a list of markets that's going to work for you. And then it gives you everything after the fact too, how to generate leads, how to go through an entire acquisitions process and build a proper funnel, and then how to close and then operate on the properties afterwards. It's pretty serious business and it's the cost of a home inspection. So if you're serious about buying one rental property, it's probably going to save you a burn inspection automatically and then make you a better buyer altogether as well. But that's enough plugs. Let's get right into it. We're going to start with a foreword on criteria and strategy. A lot of people get really hung up on picking markets. They can never actually make that choice. They get stuck because they don't have a clear criteria. They don't actually know what type of property they're looking for. It's impossible to figure out what the best markets to find properties are if you don't know what it is that you actually want to buy. So you want to understand the type of property you're looking for first. Single, multifamily, how many units, what's the year built, what's the asset class, what type of neighborhoods are you operating in. You want to actually pick a range of values. Hey, I want duplexes between $140,000 and $200,000 in C plus Midwestern neighborhoods, C plus and B minus Midwestern neighborhoods. And then you have to pick up a yield too, right? Like what's the kind of cap rate I'm looking for if you're a long-term investor? And that kind of takes us to another point here. It's hard to pick a criteria type of property like I just outlined here if you don't know what kind of strategy you're going to be using. If you're not sure if you're going to be renting out midterm to healthcare professionals or college leasing or long-term rentals or Airbnbs or whatever it might be, you're not going to be able to decide what type of property to look for. So you got to pick a strategy first, then you have to establish your criteria, and then you can start to go and pick markets using these rules that I'm about to give you. So once you've done that, here's the rules that you got to use. The first thing you're looking for when you're screening, when you're picking markets, when you're making that list of places to go hunt in is abundance. What do I mean by that? A lot of people think, oh, let me just focus on the best market to find properties in. The most important thing is actually markets that have a lot of the type of property that you're looking for, because this is a numbers game type of business where you need many at-bats to actually get a home run and get a good deal. And you're never going to find a deal if the market that you're operating in only has a few fourplexes between 300 and 350,000 in C plus neighborhoods in good condition. That's just the reality of it. So you're gonna wanna screen for abundance by hopping on. The simplest way is to just get on Zillow, set some filters for the type of property you're looking for. Go listed and maybe with some pending included, or flip over to sold if you really wanna see the history of the market with that kind of product and go, is this property available? And if it looks like it is, you might even wanna do a second screen. Hop on listsource.com. It's free to at least see how many of a type of property are there. And go enter all your criteria. Go to create your own list, play around with the filters and see how many duplexes between 150 and 200,000 are available in that zip code of Milwaukee, Wisconsin that you're looking in the first place. And if there's not that many, you're in the wrong market for your product. So abundance is really important. The second thing I do is I do a quick law screen. This is not something super in-depth. People get really hung up on landlord-tenant. They're like, hey, if I'm in Sheboygan, Wisconsin, I heard that state's a little bit tenant-leaning. That's not a disqualifier for me, right? You can make that work. What I'm talking about is the markets that are like hard no. Cook County, Illinois, where Chicago's seated. Very difficult landlord-tenant city, especially if you're dealing in like affordable housing, right? Lots of New York, lots of California, lots of New Jersey. These could be really tough markets to operate in if you're operating in an area where landlord-tenant law is something that might tilt the scale out of your favor more often than not. If you're dealing with working class properties, inexpensive neighborhoods, things like that, it could be really difficult if you don't do a law screen. So run a law screen, that's second. Third is you want to evaluate competition. And this is a little more complicated, so I'm going to try and simplify it for you. There's 4 things I look for to make sure that I can compete, or there's 4 ways to outcompete in a market for a product that meets your criteria otherwise. And you could choose one of the 4, but if you hit all 4, then you're probably winning more often, right? The first thing that you could do is you could win at execution. What does that mean? You could be better at finding properties at a discount from market value. You have a really good acquisitions engine. You could win on the execution side at rehab, at property management. You could win at selling properties. You could have a really good buyer's list like myself, and you go in wholesale and know that you can generate margins in a market, right? So execution means you could just do better at something than the other players in that market, and that creates more opportunities for you. The other way to beat competition is unsaturation. What's unsaturation? You're going in markets that maybe don't have a lot of investors, secondary markets that don't have a whole lot of activity. It's really easy to win in those compared to really saturated primary markets that have a lot of desirability factor to them, right? So looking for places where you're not dealing with a whole lot of the people that are bidding up your property. Secondaries is one way. Another thing to do is to watch out for heavily homeowner saturated neighborhoods. I know those are better neighborhoods if you're looking for A-class properties. Easier neighborhoods to manage property in, but at the same time, you're competing with someone that's willing to pay for memories, their kids' first steps, a swimming pool to swim in, right? A nice big great room, a pretty front yard, whatever it is. These are things that aren't very valuable to an investor. Someone's willing to outbid you. So focus on going where there isn't a whole lot of the people that are competing with you to drive the price up on your product. The third thing you could do to beat the competition is kind of play the contrarian game. Now we're getting a little riskier here. You have to be able to make a good decision, but looking at a market that's wrongfully, stigmatized can create opportunity for you to get deals much more easily because it turns other investors away. Maybe the Google search doesn't produce the best results, but there's something else going on. Like the population data doesn't look good on Google, but there's a massive rent growth trend that's been going on there. That's a market where you could play the contrarian game and possibly win. And then the last thing you could do, this is not what I recommend, but a lot of newer investors are willing to do this. I guess I don't recommend it long-term play. You should look to win in one of the other ways that I've given you over an extended period of time. But as you're getting started, winning by being willing to make a little less money than the next person. If you find a rehab deal that you know you could take on, that your property management could do for you, you get a pretty good discount, but it's not as much equity as a flipper would want or like an experienced burr investor would want. You only have a little bit of equity on the upside, but it gets you in the deal and it's a good deal and it's still a discount and you're willing to trade a little bit of work for it just to cut your teeth, get your feet wet, learn the game. Then winning by making a little less money than the next person can be a viable short-term strategy. So competition is extremely important. Understanding it in a market is extremely important. The next thing you're looking for in a market are drivers. Now, drivers can be complex. You could play the path of progress game where you go, hey, there's a growing city outside of here and it hasn't quite gotten to this secondary market 45 minutes away yet, but I'm seeing the writing on the wall. Rents are growing, property management's having a good time, cash flow is stronger than it is in that city, but the property is just as easy to manage and the values are just a little bit lower. That could be a great way to play the driver game. Another thing to look for is general secular trends. When rates are really low, growth markets boom, right? But when rates are higher and markets are generally expensive, value does well. Right now, value is doing pretty damn well, and we happen to deal in cash flow product, so that kind of goes hand in hand with our strategy and our investor strategy, playing in cities that are affordable, that have strong enough fundamentals for leasing and for jobs, have led to outperformance, markets that appreciated more than the trendy markets that are supposed to be growing, right? So look for drivers. If you're really serious about a city, you can call the Economic Development Committee and see what's going on, or you can just see what kind of initiatives they have going as well, right? But trajectory is what you get from drivers. Some sort of positive trajectory. It doesn't have to be perfect. It doesn't have to be a boom town or a unicorn town or the next Austin, Texas, right? It just has to have some sort of story that's leads you to believe that you're not buying something there that's going to deteriorate rapidly over time. Rapidly. If it deteriorates slowly, there's a slight risk, but you can win at the deal on the front end, then maybe that's worthwhile too, right? But those are drivers for you. And then the last thing you're looking for in a market that's you're going to want to operate in are resources. What do I mean by that? Going to a tertiary town where there's only one property manager and that property manager is actually from a completely different city, they're just willing to take on properties there, that's a bad play. You need to be in a market with enough of the key players, especially if you're an out-of-state investor. But even if you're not, you probably don't live in some like remote city without a couple property managers if you're watching this video, right? Even if you're not, to be able to delegate, you need enough people to delegate to. You need contractors, you need managers, you need enough home inspectors, you need insurance companies that are willing to take the property on, you need lenders that are willing to take the property on, right? So make sure that those resources are available in the markets that you're selecting. Google search will handle that for you. It's not that difficult. And in abundance, right? Or with redundance, not abundance. Multiples, I guess same point, right? But you want to make sure there's not just one of that thing you need, because if that one goes away, you have put too much power in a single supplier's hands, your business is no longer viable because you don't have a backup. So the 5 things that you are using to generate that list of ideal markets to go and hunt in, at least to start hunting in. Number 1 is abundance of your product. Number 2, I do a loss screen. Then I'll evaluate the competition and see how I plan to outcompete. The 4th is I'll look for drivers that lead me to believe this market's relatively undervalued or can outperform over time, or at least market perform over time. And then the 5th thing I look for is enough resources, hit the checklist. Now remember, before you do all that, have your strategy dialed in, have your criteria dialed in. And I got a final note for you guys. Are some markets really better than others? The answer is a clear and resounding no. Now, in some markets, you are more likely to find good deals than others, but the deal is evaluated on a deal by deal basis. I've got some markets, I got like one 5-unit property I bought in Valparaiso, Indiana. In the years I've been marketing there, I've gotten one deal there. I've never flipped a deal, and I ended up keeping the one deal that I got, and it was super lucky. I got this 5-unit for $350. It's worth like $600. It was worth like $525 when I bought it. It's worth more now. I never got another deal there. Does that make it a good market? It's growing. It's got great fundamentals. Managers love it. The property's performed very well, but I've never found another good deal there once. That's a terrible market with one great deal, right? So evaluate on a deal by deal basis. For a market that you want to invest in, you're just doing a simple viability check. Could it work? Often enough for it to be worth my time and effort. And then you're going out there and comparing deals at the deal level, not the market level. That's my little bit of like, breaking the common investor myths, right? It's not about the market as much as it is about the deal. Remember that, use this set of rules and go out and find some good properties.